This will change everything. I'm your host, Steve Van Metre, and thanks for joining me today. And Bill Gates, in concert with the World Health Organization, is predicting the next global pandemic could be here in a matter of a couple of years. They're even going as far as running simulations and, get this, making fake news reports of the event. But what we want to focus on is where the economy will be in a couple of years. Can it handle another pandemic and shutdown? How will central banks and governments likely respond in a fiscal and monetary way? Will they even be able to? And more importantly, how will the markets respond? We've even got news, as we've suggested on this show, that new order growth leads other aspects of the economy in the manufacturing sector, and now we're getting data out of the tech sector validating that indeed the collapse in new order growth is having some major ramifications. And plus, we've got two government agencies battling it out over whose data is the best, when we know on this show neither of them is any good. The question is, who's the best of the worst? Let's head over to the World Health Organization, where we picked today's story up with a headline, Catastrophic Contagion. And here we see the World Health Organization, in partnership with the Bill and Melinda Gates Foundation, conducted a pandemic tabletop exercise at their Grand Challenges annual meeting. And the participants included a wide variety of countries, as well as wealthy people such as Bill and Melinda Gates, to help finance this. The exercise simulated a series of WHO Emergency Health Advisory Board meetings addressing a fictional pandemic set in the very near future. And participants were challenged to make urgent policy decisions with limited information in the face of uncertainty. Of course, the question being is, how likely are governments to respond to this? But before we address that, I want you to see just how far they went with this, because they went out and they made some fake news reports and even put it on YouTube. And here you can see they're calling it the severe epidemic enterovirus respiratory syndrome of 2025. And you can see they've even got reported cases that don't even actually exist yet as they try to simulate this. Now, as we look at how the markets may respond to this, we have to understand is, where is the economy likely to be in 2025? Now, many experts believe we'll have a recession in 2023, and typically recessions last, as we talked about on yesterday's show, as Elon Musk correctly suggested, they run about a year to year and a half. At least the markets, from a market perspective, the stock market responds negatively over a year to year and a half period. So let's just say that we have a recession in mid-2023. That will put us at the front end from a market perspective in 2025. Now, from a Fed's perspective, well, let's get to that in a moment, because one of the things people will think is, just like from the pandemic, well, the stock market will surge, but maybe not. I want to give you the reason why that's not likely to happen. And here we can see the Fed, what their response was. Obviously, they were cutting rates into the pandemic, and then they sliced them right down to zero. So what we do note is that the Fed, and I want you to see, just looking back 10 years, we were out of the great financial crisis by 2013, 2014, and 2015, even by almost 2016. But notice how they kept rates at zero. So what this suggests is, if indeed we do actually have a recession, which, as we know from the yield curve, is a high probability, well, the Fed will already be at zero at this point. Now you start to wonder is, can they go negative? Well, from everything we know about the Fed and how it functions, they actually don't have the mechanisms to take the federal funds rate negative, and it has to do with money market accounts being tied to it. So it's entirely possible what we're seeing in the reverse repo market today is maybe the Fed takes rates negative, but puts a positive rate on the overnight reverse repo and tells all the banks, look, you put all your client money here, and we'll pay effectively a 0% interest rate to keep it going negative. But the challenge will be, if we do have a pandemic that soon, that central bankers around the world are likely to be back at zero already. Now, you talk about the market response. Of course, we know it rallied really hard off of those 2020 lows, but that was a lot to do with government fiscal stimulus hitting the pockets of consumers who turned around and bought stocks. This time around, if we have a recession, governments will already be running massive deficits to begin with and will be under pressure not to bail out businesses and consumers as they did in the past, which would pose a challenge if we face another shutdown. But what about inflation, you're asking? Well, yes, it's likely we'll see some inflation, particularly out of food and energy. But let's take a look at charts here because it suggests that maybe we won't see a repeat of what we just saw. And here you can see, of course, inflation collapsed during the pandemic as the global economy shut down and then surged higher, which we can directly correlate to fiscal and monetary stimulus. But now if we take out the fact that the Fed will really have limited ability if they can figure out a way to take rates negative, and governments may not be able to juice the fiscal spigots due to already massive deficits from that recession, then indeed the likeliness that we will see ongoing inflation is pretty low. In fact, we could see the next pandemic being actually deflationary. And you also have to put this in perspective that we've been going on this for almost 3 years now. In fact, in China, it's been 3 years, and look at what the headlines are saying just today. China reopens borders to world in removing last of the COVID zero curbs. So indeed, we could be facing here a pandemic, finally a recovery several years later, a recession from all this overjuiced fiscal and monetary stimulus that we didn't need. And of course, then you face another shutdown and it will have a devastating effect on the global economy. And people arriving in China will only be required to obtain a negative test within 48 hours of departure, according to the National Health Commission. That compares with the current requirement of 8 days of isolation, making travel to the country a near impossibility. But now we're seeing, as of course we knew from the pandemic this would happen, and we talked about this on the show, that there was this macro effect where we saw supply chains grind to a halt. We saw inventories start to go down because everybody drained the shelves. And then what happened is, of course, we saw the building of inventories. And then what happened, and we showed the charts on this, is that new order demand has collapsed. We've talked about this from Nike, who said they were cutting new orders. We talked about FedEx, who says, look, demand for global shipping fell off a cliff in the third quarter and has continued to decline. And now look at this headline from the Wall Street Journal. Chip inventory swell as consumers buy fewer gadgets. Now, I want to put this in perspective because you may remember the automotive industry was just trying to crank out cars as fast as they could because there was a huge demand for them. But what was one of the things they were missing? Chips. All those fancy electronic gizmos that we love, well, they didn't have the processors to run them all, and so they got backlogged. They could build the vehicles, but they didn't have the chips. Now, the tide is turning. You see that collapse in new orders, but look how it's affecting the chip sector. What is happening in chip amounts to good news for consumers who can get their hands on products from washing machines to laptops even faster. That's not inflationary. That would be disinflationary. And get this, sometimes more cheaply than a year ago. That is deflationary. And for chip makers, that has triggered a wave of job cuts and reduction in capital spending as companies try to restore profitability levels. What did we say would happen? That the collapse in new orders would eventually lead to less demand, and that would lead to layoffs and lower prices. There you're seeing it right there. Chip inventory levels are now well above our target level. As Thursday, the memory maker Micron missed its earnings projection and said it would cut 10% of its workforce. That is a leading indicator for where other chip makers are going to be. And lead times between chip orders and deliveries that swelled early in the pandemic, which led to inflation, get this, have fallen in recent months. That's again disinflationary. Inventory levels, typically measured in days, are now at their highest level in more than a decade. That's 10 years, or about 40 days above the median for the chip industry and supply chain. And so what you had happen is everyone believed the economy was going to boom. They cranked up production. They hired a ton of people. Inventories ballooned. And as fiscal and monetary stimulus got pulled back, well, guess what? They left a big vacuum of demand, and now we're seeing that play out. Today we have a large inventory, especially on the consumer side, so it's not just on the manufacturing side, which is driving very aggressive pricing because all of us are trying to reduce those inventories according to this was HP. Dell struck a similar note in November saying distributors of PCs were rolling out promotions in an increasingly price competitive market, though itself wasn't discounting. Well, we'll say at least not yet, and that again is not inflationary. Those are disinflationary and even deflationary pulses, which will eventually get caught up in the consumer price index. But as we talk now about government data, and we talk about them being wrong as we covered in a recent show, now they're going at each other. Fed fight as Biden's BLS lashes out at Philly Fed over million job revision. The BLS does not believe that the monthly CS data, remember we covered this in a recent show, dramatically overestimated employment growth, though all survey data contains error and revisions are necessary part of the statistical estimation process to ensure accuracy. But check this out. In the past, other regional Fed Reserve banks have conducted similar research using various methodologies. However, the Bureau of Labor Statistics has determined, following years of research and engagement with the Federal Reserve banks and data users, that this general approach resulted in lower quality data. So there you have it. If you disagree with the Bureau of Labor Statistics for any reason, you must have lower quality data because they've got the best. But they don't leave the fight there. They keep digging in. The BLS employment data from the current employment statistics survey are widely recognized as a key indicator of labor market performance, in large part because of the consistent, transparent message used to produce timely and accurate statistics. Of course, we know that it is not accurate at all because the report to begin with is smooth. You see those big bumps, they get smoothed down. You see big drops, they get smoothed up. So the accuracy of this report is strongly questionable, as many experts say it's one of the most inaccurate reports the government puts out. Once a year, the BLS revises the official monthly estimates by benchmarking to a BLS quarterly administrative data report that is available with a 5-month lag. And historically, the CES estimates of national employment are extremely reliable. Last year, which included the effects of pandemic on labor market, the revision was only minus 7,000 or less than 0.05%. Using a simple methodology and a series of assumptions, the Philly Fed Reserve Bank benchmarked to a less complete version of the data that is available to the BLS. So there you have it. According to the Bureau of Labor Statistics, they are the gold standard. They are right, even though their data is highly lagged and, as we know, highly inaccurate. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.